I'm Marianne Kibler, and today I'm going to be helping you learn about credit cards, charge cards, and credit in general, how to use them wisely, responsibly, and more importantly, to your advantage. To give you a little background about myself, I'm a CPA or certified public accountant, and I have more than 25 years experience in banking, finance, and accounting. So let's begin. The objectives of this course is to describe the purpose of charge cards and credit cards, to determine which credit card is best for you, or if a credit card is even a good option for you. We'll identify the factors that credit card companies look for when making credit decisions. We'll describe how to use a credit card responsibly, and we'll identify the steps to take when a credit card is lost or stolen. So why is credit important? Credit can be useful in times of emergency. Say your car breaks down and you need to be able to get your car repaired, and you don't have that amount of cash on you. Then if you have a credit card, it can be very useful in times of emergencies. It's also more convenient and far safer than carrying large amounts of cash. I myself do not carry very much cash anymore. I have 2 charge cards and I keep my cash to probably about $20. That's it. It's much safer that way. It also allows you to make a large purchase, for example, a car or a house, and pay for it over time. Most people cannot save the money to either purchase a car outright and certainly to buy a house outright. So it's smart to go ahead and take a loan out for that and pay it over time. And a credit can also affect your ability to obtain a job, buy or rent a house, or obtain insurance. In most of these situations, the landlord or whoever is your employer is going to be running a credit check on you to see if you're responsible with money. So what is a credit card? Credit cards, they're just a convenient form of borrowing. They provide a revolving line of credit. They require you to pay the minimum payment each month. Now, of course, you can pay much more than minimum payment. We'll get into that more later. Charge cards, on the other hand, are a little bit different. They require you to pay the entire balance every month. They used to be a lot more common. American Express used to only have charge cards, so you'd have to pay the balance off every month, but now they have credit cards as well. A lot of businesses still have charge cards, where, especially with American Express, where they're required to pay the balance in full every month. So that's the difference between the two. ATM or debit cards. ATM, or automated teller machine cards, are debit cards that are tied directly to your checking account at a bank. So before you use one of those, you have to make sure you have enough money in your checking account before you use an ATM or debit card, or you will overdraft your account. Stored value cards. So different types of stored value cards are payroll cards, government disbursement cards, general purpose cards, and probably more commonly known gift cards. And stored value cards are just what they sound like. There is a certain value of money that is stored on that card because you're going to be paying for it up front. And then when you use the card, or whoever you give it to uses the card, then that value will decrease as they make purchases. However, you cannot build a credit history with stored value cards because you're paying for that card up front. So it's just like getting a money order. You give them money, you get the card, there's a certain amount of money on there, and when it's gone, then that's all there is. So it's not a loan, it's basically you're paying for the right to use that card up front. Secured and unsecured cards. Most credit cards are unsecured. This means that they don't require any collateral. And all a collateral is an asset that you promise to give the bank if you do not repay a loan. So for example, a car loan, you take out a car loan. The company that you get that car loan from, the bank or the organization, is going to have that car title in their name. So if you do not pay, in a timely manner and you get too far behind on it, they're going to repossess the car. Same thing with a mortgage. If you don't make your mortgage payments, the mortgage is secured by the house, and they're going to foreclose on the house if you do not pay it back. So a secured credit card, you may want to consider that if you've had no credit history or have had credit problems in the past. And a secured credit card just means that you've made a deposit on the credit card to the organization, to the bank, the company that issues the credit card, and then they're assured that they're going to have the money back. So for example, if you wanted a card, if they offered you a card for $300 limit, you're going to have to give the bank, or the organization, Visa, MasterCard, $300, and they're going to keep that as a deposit. So just in case you don't pay the bill on time, then they can recoup their money. Now that is a refundable deposit. You will get that back if you ever close the card, or if once you establish that you have good credit, then they'll either refund it back or you can ask them for a refund back. So that's a good option as well. Student credit cards. They usually have lower credit limits. And they're intended to help young people establish credit, typically in college, because you do have to be 21 years old to apply for a credit card. And you need to remember to read the terms and conditions, and we'll get more into that later. Here's some statistics about student credit cards. In 2019, approximately 83% of undergraduates had at least one credit card when they graduated. Only 60%, however, of undergraduates paid off their credit card balances each month. That means 40% of them were carrying a balance when they graduated. And here's the scary statistics. College seniors graduate with an average balance of more than $2,351. Many, however, graduate more than $10,000 in credit card debt or even more. So be very careful once you get a credit card, no matter what age you are, that you pay it off in full every month, or pay at least as much as you can, and be very aware of what your balance is. Otherwise, when you graduate, not only will you most likely have student debt, you'll also have credit card debt, and that is going to be very difficult to pay off. Rewards cards. Rewards cards are credit cards where you earn points towards goods or services. And those credit cards are typically airline credit cards or hotel credit cards. And every time you make a purchase, then you earn points towards either a flight, an airline flight, or toward a hotel. However, that can be sometimes difficult to use because they might have blackout dates, or it might be difficult to get a flight that you want to get because it's booked up or it's blacked out. So the other alternative, you can earn cash rebates back, which is what I do, okay? Typically, you might have a choice, and I always get the cash rebates back because that way I can either get a check from the credit card company every month, or I can just apply it against my balance, which is just as good as getting cash back. And then that way I'm free to use that cash any way that I would like. And many of these rewards cards do charge an annual fee. I have 2 rewards cards right now, and I don't pay any annual fee, but I have good established credit. But you can shop around for that as well. If you do pay an annual fee, keep it as low as possible, and make sure that any rewards you expect to earn justify that amount of fee. Otherwise, they're making the money and you're not. Pre-approved offers. You've probably seen pre-approved offers in the mail. You're pre-approved for a credit card, for a Visa or MasterCard. However, there are no guarantees. That's just a marketing ploy. You are pre-approved, but you must still qualify for the card, so you're really not, because if you don't qualify, they're not going to give you a credit card. So just so you understand the difference. And you need to read the agreement carefully and shop around. We'll get more into that later about for the best terms. If you want to opt out of getting pre-approved offers, if it's annoying and you're getting a lot of these offers, you can either call this number on the screen, or you can visit www.optoutprescreen.com and opt out of the pre-approved offers. So truth in lending disclosure. This is a document that's legally required for any loans, any credit cards, and it states that all the credit card terms, including specific account fees, the reason why penalty rates may be applied, and key terms, both when you open up the account and when terms are changed. So terms can be changed, but they're required by law to do that in writing. And we'll get more into terms later on in account fees. So credit card terms. You want to read the disclosures for important credit card terms. The most important one probably is your annual percentage rate, otherwise known as APR. So when you see APR, that just means the interest rate or the finance rate that the credit card company is charging you for loaning the money. And they will charge you interest on the outstanding balance if you don't pay it off every month. So, and those percentage rates can go all the way up to 28%, or it can be as low as introductory rate of 0% for a year. So you want to read the annual percentage rate. If you do get a low intro rate, read what it's going to go up to after a year and make darn sure that you're not carrying a balance on that if at all possible. It also has to disclose what the fees are. And there are a lot of fees, and we'll get into that a little bit later too. There are various fees that they can charge you. Again, shop around, because a lot of credit cards, especially if you have good credit and have established good credits, will waive a lot of these fees or do not have these fees. And then there is usually, there can be a grace period. It's not very common in credit cards, but there can be a grace period. And that just means if you go past the due date of the payment, they might give you 5 days, 10 days to make that payment before they charge you a penalty. It's more common in mortgages or car loans to have some type of grace period. Very few credit cards have a grace period. And then finally, how they compute the balance computation method, how they compute interest on what balance. So it can be a daily balance or it can be an average balance. So they're required by law to tell you how they're calculating the interest on your credit card. The APR, that's just the cost of borrowing money on a yearly basis. Again, it includes interest and fees. So the credit card company is going to give you a credit limit and they're going to handle the transactions. In exchange, if you carry a balance, and most people do carry a balance, unfortunately, then they're going to be collecting interest from you, and it can be very sizable. The rate can be either fixed or variable. Most credit cards are a fixed rate. Actually, credit cards are a fixed rate and not a variable rate. You'll run into variable rates when you get a mortgage. Typically, when you get a mortgage, you have a choice. A fixed rate is just like it sounds. The interest rate is fixed. It doesn't change. If you open up an account at 12%, it's going to stay 12% unless they change the interest rates and they have to notify you. If it's a mortgage, it will stay that amount over the entire length of the mortgage. If it's a variable rate, it's usually tied to market indexes for the bonds and treasury bills. And that means that it can go up as the market fluctuates up and down. And the market always fluctuates up and down. It's been very low lately, but it can go up. So be very aware of that, what type of interest rates you're getting. Different APR for types of use. So there's different APR, different interest rates, depending on what you use your credit card for. There's a different rate for purchases, there's a different rate for balance transfers, cash advances, and penalties. And here's the fees that we were talking about. This lists all the different types of fees, and there's quite a few of them. So you want to read your truth in lending disclosure document very carefully. There's annual fees. If you pay an annual fee for a card, I would avoid that unless you absolutely have to. There's a lot of credit cards out there. Shop around. Use your computer and look for a credit card that does not carry an annual fee, because that's just more money you have to pay. There's a late fee. So if you're even 1 day late and there's no grace period, and there typically isn't on a credit card, you'll pay a late fee. Can be as much as $50, $60. There's over the limit fee. So let's say your credit card, you have a limit of $300 and you by mistake or because you needed to, all of a sudden have spent $400. They're going to charge you a fee for that as well. There is a fee to transfer a balance. So say you have one credit card and you want to transfer that balance to a lower interest rate card, they're going to charge you a fee to do that. There's a fee to increase your credit limit. So let's say you recall and would like to have a higher limit. Sometimes they can charge you a fee for that as well. And then finally, a foreign transaction fee. So let's say you go to Mexico and you use your credit card, which is very convenient. There is a fee for that because they have to then work with the foreign currency, and that is costing them money. So there's a foreign transaction fee. Now, again, shop around. I will tell you that I don't, pay, there's a late fee probably on mine, but the other fees on my credit cards, there is no fee for that, and they have to disclose that. And if you have any questions, always ask that up front. It's good to know. Grace period, we talked about that. So you want to avoid or minimize the finance charges by paying your balance in full, and certainly before the due date or before any grace period runs out. And you need to either pay your balance in full or make the minimum payment on or before the due date. Don't cut it close. You can do this online, which is how I pay my bills, which I know for sure that they're going to get it. So that's probably the most convenient way to pay it. Many credit card companies never provide a grace period for cash advances or balance transfers. So if they give you a grace period and you take out a cash advance or you transfer a balance, then there is not going to be any grace period for that. So you really want to avoid any kind of a finance charge for that. Other factors to consider when you're looking at credit cards is how's their customer service? What kind of additional protection do they give you? For example, if you make a major purchase, a lot of times credit cards will give you an extended warranty on that. And then what's your credit limit? So, typically the credit card company is going to give you a credit limit based on how much money you make and how your credit history is. So typically when you first get your credit card, it's probably going to be as low as $300. Over time, as your earning potential increases and you show that you can handle the credit card responsibly and pay it on time, pay your bills on time, then that amount will typically go up. Or you can call your credit card company after you've been with them for a little while and request a credit limit increase. So it's good to have a little bit more of a credit limit in case there is an emergency, like a car repair or something, because if it's only $300, that may be difficult to cover an emergency purchase. So applying for credit. When you apply for credit, there's two different types of credit that you can apply for. The most common is individual credit, and that's based on your own assets, things that you own, your own income, typically from a job, but it can be other forms of income as well, your ability to pay. So in other words, how much debt do you have? How much do you owe, besides what you're applying for? And most importantly, your credit history. And your credit history is just how have you been paying your bills? Have you been paying them timely? Do you have anything negative on your credit history where you forgot to pay a bill or you've even maybe defaulted on a loan? And that's going to affect your credit history. We'll get more into that later. Joint credit, on the other hand, is where you are applying with another individual. Typically that's a spouse, but it could be a parent or otherwise, but typically it's a spouse. Joint credit is based on the assets, income, ability to pay, and credit history of both applicants. Now this gets really important when you get into things like mortgages or car loans or things like that, because if you are applying with someone, say that your credit is very good and you have good income and ability to pay, but the person that you're applying with, the other person, your spouse, for example, may have horrible credit, may have bad credit, or may have low income. So they're going to look at both of you because you're both responsible for paying the bill. And that's very important to keep in mind. If you get a joint credit, either any type of a loan or a credit card or a mortgage, and you are just as responsible for paying that debt as the other person is. If the other person can't pay it, then you're going to be fully responsible for the debt. So be very, very careful before you take out any kind of joint credit, that the other person is going to be responsible with it as well, because they can rack up debt, for example, on a credit card, and then not pay it, and you're responsible for their purchases. If it's an individual credit, that can happen. Application requirements. You must be at least 21 years old unless you can show you have independent means of repaying the debt. And typically that means you may be under 21 years old and have a really good part-time job, or like my son, you could be working full-time and going to school at the same time. So he was able to get a credit card on his own before he was 21 years old, or you have a cosigner. Now, cosigning usually comes into play on car loans and mortgages, but be very careful. I would never cosign on any loan. The danger with cosigning is that if that person does not pay the mortgage or the car loan or whatever type of debt it is, if they don't pay it on time, you may not know about it, probably don't know about it, and yet it's going to negatively affect your credit. It's going to be a black mark on your credit. And if they just default on it completely and refuse to pay, you're a cosigner. That means you have 100% liability if the original signer does not pay on the loan. So be very aware of that. And like I said, I would far rather just loan someone the money and have them pay me back directly than put my credit at risk. Provide false information on a credit application is a crime. So don't lie on the credit application. Be very honest about how much you make and whatever other questions that they ask you. So a credit report. A credit report is basically a report that tells creditors, people that you're trying to borrow money from, who you are, how much debt you have, whether you've made payments on time, and whether there is negative information about you in public records. Negative information, for example, like a bankruptcy, anything that would be negative, that's public information would be on there. And how many inquiries are listed on your credit report. The more inquiries that are on there, let's say, for example, you applied for 5 different credit cards at the same time. That's not a good situation, because if you are approved for, say, 4 of those cards or 5 of those cards, then that's going to be a huge amount of available credit that you could run up, and it would impact your ability to pay that debt back. So if you make a lot of inquiries, into applying for a credit card, they're called inquiries, then on the credit report, then your credit score is going to be much lower. And we'll get into credit scores in a little bit. So just be aware of that. There's 3 main credit reporting agencies: Equifax, Experian, and TransUnion. And all 3 of those are required by law to give you a free, please keep in mind, free annual credit report. And they're very easy to get. You can visit www.annualcreditreport.com or call the number on the screen, or even mail in a request. And so very easy for any of those 3 to get it. Good idea to check your credit report, your free credit report, once a year, so you know what the creditors are looking at, and you can check the information to make sure that everything on there is correct and accurate. If you find a problem, then contact them, get it in writing, tell them what the problem is, and they're required by law to investigate, and if it's wrong information, to remove it. And then you ask for another credit report to make sure that any incorrect information is off of there. Very important to do. And credit scores. So when a credit report is run, they're going to give any potential lender or creditor, they're going to give it a score on you. And the scores range anywhere from 300 to 850. There's two types, and they help to determine what your credit risk is. The higher the score, the better the credit risk. Let's say you have perfect credit, it could be close to 850. And let's say that you didn't pay your bills on time, you're just starting to try to establish credit, it could be closer to the 300. So there's two different types of credit scores. There's the FICO score and the Vantage score. And so there's a lot of information that goes into determining what your credit score is going to be. If you're denied for credit, so let's say you apply for a credit card or a loan and you're turned down, you have the right to have the credit card company or any lender give you the reasons that the credit was denied. And reasons for denial might include bad credit history, you didn't pay your bills on time, you defaulted on a loan, you've got bankruptcy. Those are all reasons for denial, or you don't meet the income or residency criteria. Let's say you don't make enough income, you have a part-time job, you're only making, $100 a week. You probably are not going to get a credit card. Lost or stolen credit cards. Credit cards can be lost or they can be stolen. And if that happens, you need to call your credit card company immediately if your card is lost or stolen. Or even more importantly, you identify errors on your statement. So if you're a victim of identity theft or you've made an online purchase and all of a sudden you see a lot of charges on your statement that are not yours, then you've been a victim of someone stealing your credit card information. However, the good news with a credit card company, if your credit card is stolen or compromised, is that you are only liable for $50. And that's only if you don't call them right away. If you call them immediately as soon as you find out about it, then you're not liable for a penny. Then they need to go back and they need to collect that from the company that made that charge. Never, ever give out your confidential personal information over the telephone or over the internet unless you've made the call or you've made the inquiry. Don't ever do that. Don't ever give that out. So I mentioned identity theft. What is identity theft? That's when thieves steal your personal information and pretend to be you. And that is a serious problem. We're talking billions of dollars here. So we need to do everything you can to make sure that your personal information stays as safe as possible. Common forms of identity theft. One of them is phishing, and that's unsolicited emails that appear to be from legitimate sources. So you're going to get an email and it's going to be looking like it's coming from a legitimate source, and it's not. Farming. Fake websites that seek personal or private information by appearing legitimate. Again, they're going to be looking at a website that looks like it's from the IRS or Social Security, but there's just something a little different in that URL, the address, that will show you that it's not. So again, be very careful of these type of scams. Skimming. Skimming is actually a special storage device, usually very small, very hard to detect, that is used to obtain credit and debit card numbers when you use your card. Typically, you'll see these type of devices are found at gas stations, okay? When you're at the pump, when you're getting gas, or at ATM machines. So if you see anything unusual looking at an ATM or a gas station pump, do not swipe your card, go inside, talk to either a representative of the bank or the gas station and tell them that there's a problem, that you believe that there's some kind of a device on there that's obtaining credit card numbers. If you are a victim of identity theft, then you need to call the Federal Trade Commission, FTC. You can go online, www.ftc.gov/ID theft, or the phone number given below, and report that. And they will tell you what steps to take at that point. Credit card statement information. Just like a bank statement, you'll get a credit card statement monthly. You can also go online, which is what I do, and you can look at your account transactions and information at any point during the month, and that's what I prefer to do. You can either get a credit card statement in writing or you can get it online. And again, I prefer to get all mine online. And in that credit card statement, you're going to have account summary, how much was your beginning balance, how much did you spend your purchases, what payments were made, and then an ending balance. It's going to give you payment information, how to make a payment. It's going to tell you what's the minimum amount to pay, and then what your total balance is. And again, minimum amount to pay doesn't mean that's all you can pay. Either pay the balance off every month or pay as much as you can. And that's important to keep your interest rates as low as possible and not build up a lot of debt. It'll have a credit counseling statement, a notice of any interest rate changes, Transactions or account activity, and that's just basically all the purchases that you've made during the month or any cash advances or any refunds that you've gotten back, and how they calculate your interest charge calculation, how that interest, let's say you don't pay off your bill every month, they're going to have to show you how did they calculate that interest charge. You want to keep good records for charge cards, okay? Credit cards. You want to keep your credit card, either credit card or charge cards. You need to keep good records. You want to keep your credit card receipts or charge card receipts to compare with your monthly statements, or compare it online if you pull up the transactions, interim before the month's over. And you want to keep those until at least you compare that it's the right amount. Let's say you go out to dinner and you gave a 10% tip. All of a sudden it turns into a 50% tip. All right, well, you can certainly dispute that, and you want to make sure that the amount that you put down on the charge card on your receipt is what you're actually being billed for. Although it's very unusual that it will be different, it can happen. You want to check your monthly statement for any mistakes. If there's a purchase on there that you did not make, obviously that's a mistake, and you want to report it right away. Call the number. Every credit card statement's got a phone number on there for customer service, or it's right on the back of your charge card, your credit card or charge card. Pay your credit card bill. Pay attention to and consider your credit limit when you pay your credit card bill, what the minimum payment is, and how increased payments affect what you owe. Again, I'm a big fan of paying credit cards off every month. I can't stress that enough. It's a good way to avoid paying any interest charge, and also to make sure that you don't get so far into debt that you can't get out from under. So pay close attention to these different things here. If you have to carry a balance, keep in mind, say it's a $300 limit on your card and you've spent $275 or close to $300 and you only make a $25 payment, that doesn't give you any credit left to be able to use. So make sure you do pay attention to that. And here's just some common credit card questions that have come up, okay? First one, should you pay only the minimum amount due on a credit card so you have more money to spend on other things? Well, that sounds exciting, doesn't it? So if I only pay the minimum amount, then I can use my paycheck and I can go buy other things. No, not really a good idea. It's far better to pay off the entire balance in full each month. Get in the habit of doing that right off the bat and make it a lifelong habit. I don't buy something unless I know I can pay it off in full each month. Otherwise, you rack up interest charges. So you're making the credit card companies a lot of money. And again, credit cards can be as high as 20, 28, 30%, okay? So even if it's 12%, that's a lot of interest to pay. And you also risk falling into too much debt. We talked about people graduating from college with over $10,000 in debt. And there's certainly plenty of people that are out of college that rack up credit card debt. Only use credit cards for purchases if you can afford to pay the balance in full each month, unless it's a true emergency. If it's a true emergency, your car broke down and you need to get to work, then pay that off as quickly as you can. Then you might not be able to pay it off that month, and that's fine, but pay it off as soon as you can. And here's an example of that. So minimum payment, maximum cost. That means if you make the minimum payment, you're going to be paying the absolute maximum amount of interest over the years, and it's going to take you a very long time to pay off that credit card. Let's give you an example. So you have a credit card with a minimum payment only, and it has a credit card balance of $5,000, an APR of 21.21%, which is the average balance on credit cards. So as you can see, that's a very, very high interest rates. And minimum payments as 2% of your credit card balance. So if you just made the minimum payment only, which would be 2% of that $5,000, if you just made only that minimum payment every month, it would take you over 30 years and $21,643.83 in finance charges or interest to pay off that debt. So let's say you buy furniture for your house and you've paid $5,000 for that, and then you just make the minimum payments. Well, not only have you spent the $5,000, but you're going to then pay an additional $21,000, almost $22,000 in interest charges, and it's going to take you 30 years to pay it off. So credit card companies love you to pay only the minimum payment because they are making a tremendous amount of money off of that interest. So use this to your advantage and don't fall into this trap. If you increased your payments to $125 a month in our prior example, that would allow you to pay off the same debt in less than 6 years and spend only $3,770 in interest. The more you pay towards your debt, the faster you pay it off and the more you'll save in interest. So let's say you can't afford to pay off a huge debt, like a huge emergency, like a car repair. Then pay off as much as you can. Pay it off as quickly as you can, and you'll pay as little interest as you can, and it'll free up debt. In our example, if you did this, you would save almost $18,000 just by increasing your payment and keeping it at the same level until your balance is completely repaid. So why give the credit cards companies $18,000 when you can have that in your own bank account? Another question, when should you use a credit card rather than a debit card and vice versa? Well, you would use a credit card to establish and build credit. You can't do that with a debit card because the debit card is coming right out of your bank account. So it's not a lending situation. So you also have more protection with a credit card if it's lost or stolen than a debit card. If you can't get a credit card, then using a debit card does make sense. Just be very careful to ensure you have enough funds in your bank account to cover purchases when you're using the debit cards. Very, very important. Any ATM machine, or you can check it online. You can check your bank account online on your phone, and make sure that there's enough available funds in there to cover any purchases or any cash withdrawals that you want to make. Well, late payments of credit cards affect my credit score. As long as you pay before 30 days after the due date, it will not affect your credit report that you're late, okay? It has to be past 30 days to show up in a credit report. However, if you pay after 30 days, the late payment will show up on your credit report and hurt your credit score. We talked about credit scores before. So very important not to make a late payment. However, even if you pay before the 30 days late, you'll still incur late fees, which can be substantial. If you're paying after even 1 day late, you're going to incur late fees. It may not show up on your credit report, but you're going to have to pay late fees. Also, the credit card company can raise your interest rate if you make just one late payment. And that again will be in the disclosures that you'll get. So make sure that you read that, and you want to avoid that as well. So the penalties for making any payment late, even a day late, are high. Now, let's say you mailed in a check, okay, or you forgot this month and you paid it a day or two late. I would recommend calling your credit card company or your charge card company and explaining the situation, or any type of loan you take out, explain the situation. And if you've got a good record with them, they most likely will reverse that fee, and ask them to reverse the fee. So they want to keep you as a customer, and if it's just a true mistake, then they probably will reverse the fee. And my philosophy is it never hurts to ask. So congratulations. You've learned the purpose of credit cards. You've learned where you can go to apply for a credit card. Very easy to apply for them online. How to decide which credit card is best for you, or if a credit card is a good idea for you at this point. And what credit card companies look for before they issue you a card. You've also learned how to use a card responsibly and how to safeguard against identity theft. So this is the end of Charge It Right. I hope that you have learned a lot about credit and how to use it wisely and responsibly. And thank you for listening, and have a great day.